Okay, good morning everyone. Welcome to the brief for the 21st of July 2017. These months seem to be flying past, well into the second half of 2017 already. Okay, well, we're going to start off just having a look at the charts, looking at some of the reactions we saw yesterday in the European equities following the ECB rate decision and press conference, so on and so forth. So we'll be looking at the euro, the DAX and the Bund. At the time, a lot of people were quite confused as to why the euro moved in the manner that it did. In hindsight, I can understand that there was quite a bit of dovish commentary, but all in all, it was pretty much in line with his Sintra speech, and nothing really changed there. So I'll be discussing that. The only caveat to the move yesterday was the bunds. They stayed pretty much stable throughout the whole session. So we'll look at that in just a moment. But just looking at the equity market, cash open, gone by. DAX started off on the back foot, as we can expect, as the market interpreted the ECB commentary yesterday as being relatively hawkish. We saw the euro strengthen, as we can see in the top left-hand chart, and the DAX sort of start to fall. Now, coming in the morning, we saw a small continuation of this. DAX just came down to test the 124, so 12,400. Euro came to test its highs. Both have now just come off some of their, well, DAX coming off their worst levels, Euro coming off its best levels. Guys, we're going to give it one moment. I think there's been an issue with the sound in the other room. Is that okay? Okay, yeah, so just carrying on. The DAX is under a bit of pressure, Euro popped higher, but ultimately they've sort of come off their best and worst levels respectively, trading about halfway at the moment. So if we look at the DAX, to 60-minute chart, yesterday's session was largely capped by S2, which also coincided with the low we saw on the 18th. Providing great support, coming back, pivot working very well as resistance. Now we're sort of nice and quiet. There's not a lot of data coming out today, so I'd expect this market definitely still have a bearish bias on the European equities as a whole, but I wouldn't be sort of expecting huge sell-off just given the fact that there's no data and there's plenty of action still to come and many pieces of data to digest in the week ahead. So bearish bias on the European equities, which seems to be working relatively well, particularly on the European equities as opposed to the American equities, which has almost been shooting itself in the foot recently if you've been looking to take a short in any of those positions. So if we just now look at the Bund as well, so there's a better sense of what's going on. So we're seeing the Bund on its highs at the moment. So the Bund once again not really reflecting that hawkish commentary. The Bund we would expect in a traditional hawkish manner to be coming off its best levels, maybe pushing for session lows as yields rise in expectations for the ECB to tighten their policy. But once again we're seeing it sort of hover around. Not much conviction in this move. Been testing that R1 throughout the end of the Asian session, beginning of the European session over here. Coming in about 7 hours, the European session as a whole. So once again, the Bund, unlike last time we saw after the Sintra meeting, what we saw was the Bund was being the lead indicator. If we saw that pushing for session lows, we saw the DAX follow suit, and this sort of continued until the hawkish commentary was priced in, and that took about a couple of days. This isn't the situation at the moment. I'd like to try to explain well, just having a look at where the markets are respectively priced and start to explain why we may not have seen the Bund react traditionally. So this is 27th of June. This is where Mario Draghi, and it's important to know, Mario Draghi was bullish on the economy. He was saying that he was bullish on the economy and that the recovery in the Eurozone economies was what was going to drive inflation. This move wasn't driven by him saying inflation is approaching target by any means. He was always very aware that inflation was still lower, but the bullishness of his statements of the economy is what led the euro to then continue to rally, as a stronger economy as a whole would result in tighter monetary policy. That's again what we saw yesterday. But if we now look at where the euro is priced over here, I know a lot of people look at the dailies. Daily charts, your hourly charts, maybe your 4 hourly charts, but it's always good to bring it up onto a long time frame, particularly after you see such aggressive moves in the market, just to see what levels we're approaching. You can see over here we're breaching some very critical levels, coming right at the top of the range at the moment. So this aggressiveness that we saw yesterday, I feel somewhat can be explained by these sort of levels almost providing a sort of gravitational effect, meaning people who are long and are buying into the euro, and I think they were justified to do so, would be targeting these extremities of the market to book profit. So they're not booking profit prematurely, chasing momentum because there's obvious targets for the market to reach. The bears in the market, on the other hand, aren't willing to jump in just yet when we're only 0.2, 0.3% away from very historic technical levels. This results in the market sort of gravitating towards these levels. Plus, this was also helped by the dollar weakness with what we saw with Trump trying to, Mueller expanding his investigation into Trump's dealings. Once again, this whole Russia situation, and that's obviously flared up. Similarly, what we saw to the FBI director, political risk being the driving factor over there. We'll talk about that just slightly, but this saw the acceleration, not just the euro strength, but that dollar weakness play. An interesting trade there was the dollar yen. We saw equities falling off, as we'd expect to see, and as what we saw with Comey, I believe. This equity selling off, which is sending us into a risk-off environment. With a risk-off environment, you'll see yen going bid. With yen going bid and the political uncertainty, you'll see the dollar selling off. This is where understanding your currencies and their individual fundamentals and correlations can provide you with great opportunity. Because yes, we were seeing dollar weakness, and you could have gone long sterling or long euro playing on the dollar. However, given the fact that this was a political risk once again, we'll touch upon the article in a moment. We'd see the dollar sell off as well as the yen go bid in that risk off environment. So this was a good short, technically held out really well. Here, S1 really defining these sort of lows here. I actually took this trade. It was a bit of an uncomfortable trade to be in at the time because of the manner in which the dollar yen reacted. We sort of broke this Asian session low, and then it was free fall, basically, all the way till pivot. So we had huge fundamentals driving this lower, but when you see any market approach a level so fast, your immediate reaction shouldn't be, let's go short, let's go short. It's let's see how the market will react here. So because we free fell there, on one hand, I was very bearish on this market and expected it to go down. On the second, I was also acutely aware that we'll see some profit taking here and we may see a bounce. So I did, even though it doesn't look like it here, I did hesitate. I gave it a few minutes before getting involved. There you go, as you can see over here. Over here. It's a 21-minute chart, that's why. Let's just get that same trade up on a 1 minute to sort of start shedding some light. Okay, so I didn't get involved straight away, as you can see over here. I gave it a moment. I wanted to see, I truly believe this was going to go lower. We saw gold going bid, T-notes going bid as well, so there's definite flow into safe havens at that time there. I gave it about a minute, and then when it came to test this level again, I thought, okay, fine, this is the end of that profit-taking situation I was talking about, so I went short here. My stop was just above this level as I marked up here, ultimately getting stopped out just around here. I then once again saw gold break R1. The news had only been out for about 5 minutes. I don't think it's been fully digested. Then took on another short around these levels. This break here. Target 1 was just there. Target 2 S2, and ultimately walked away with a little bit there, recovering from some of the losses there. So understanding currency pairs is something I talk to the stage 2 people about. Understand the correlations and the various fundamentals regarding that market. It will give you more opportunistic trades. Dollar weakness is dollar weakness. You'll see it across most of your currency pairs, but some will be more opportunistic and more driven given the fact that this was a risk move. So looking again, once the euro managed to rally pretty hard, backed up by that dollar weakness, as we would sort of expect. Draghi didn't change his commentary whatsoever. He stayed on track. If we look at the DAX came off some of its best levels, traded all the way down to S2, being supported by a previous low on the 18th, which worked very well. So this is all in line with sort of hawkishness from the ECB. The Bund, however, didn't really do much. It chopped around, but then if we look at it on a longer time frame, we have seen quite a huge correction in the fixed income space here. And even though you may be used to seeing red candles of this size in equity markets, maybe not in 2017, but definitely back in 2016, where the markets were a bit more volatile, people invest in treasuries because they feel that they are safer. What do they mean by safer? They're exposed to less volatility. So yes, this sort of sell-off wouldn't be that dramatic if this was an equity market. But given that this is a fixed income market, we've already seen quite a dramatic repricing on the back of hawkish commentary from the ECB. So all in all, I was quite comfortable with the move yesterday. That's now started to negate. We've started seeing inverse correlation, Bunds going higher, DAX going lower. It's a bit more of a risk play. I know a lot of people in the short have spent a little bit too much time on that topic, but I thought it would be good to sort of explain my views on that. And I expect, if R1 can hold up, I'm not really advising a short, but I think that's going to be a very strong technical level to get through. Okay, there was a number of things I still wanted to discuss with the ECB. I'll quickly flick over to just looking at the fact that the Eurozone inflation hasn't started falling anywhere near as quickly as US inflation has. Core inflation is actually pretty stable. Your Euro area composite PMI is nice and strong. It's around this 56.1 mark, which according to Credit Suisse is the level which governs the ECB decision making. So ECB composite PMI above 56.1, yes, they hiked 12 out of 15 times. No, was it Germany? IFO expectations above 98.3, yes, then they've left rates unchanged. And what they're also stating here is that the PMIs, sentiment data, is much more influential in trying to predict what the ECB is going to do as opposed to inflation. And even though inflation hasn't been that bad of a story so far. Okay, so just moving on, I want to talk about sterling as well. I was guilty. I took the long in sterling yesterday. We had good readings, but this is one of the things you've got to be in it to win it. Ultimately, this retail sales story was seasonal, so we didn't see a continuation of that move. But sort of looking at it on a longer time frame, the sterling currency has been ramping higher on the back of inflation, going higher and higher and higher, and almost immune to political risk at this point, knowing that the bank finger would have to intervene at some point or another. But now that we saw the inflation rate actually tick lower, this has given the market some calm, or sterling traders some calm, that this is not imminent, that the Bank of England now has to intervene. So now the immunity that sterling was seeing to political risk is starting to become a little bit subdued, and I once again am bearish on the sterling currency. You guys know my feelings on Theresa May. I think I've got to a point where it's become so difficult for her to do her job that I honestly pity her. Her approval rating through the floor. She has really limited friends in her cabinet as well. Transition, sorry. So once again, we can start looking at the fact that March, April, May, June, July's gone, 4 months have gone by, and really no real developments in the Brexit negotiations. We still haven't even managed to agree, even start to discuss about a price that we're going to pay for us leaving, or the divorce bill as it's called. So I don't feel this is positive going forward. Of course, the inflation story is definitely going to be important, but looking at sort of political risk over in this space, I'm still looking for a short in cable now. And now this inflation story started to go away. Looking at the pivot today, it's the 1.3, and as we knew, the 1.3 was a very a strong resistance point, acting many times. We did get some chop, but it got reaffirmed in the early part of July. Today lands exactly on the pivot, and this is one of those twofold reasonings you need to get into any trade. This is pivot as well as right next to quite a critical handle. If we can get through there, definitely open up some more downside. Technically, this trade was pretty good in the morning. Yesterday's the high at the end of the European session. Technically a good place to be looking to go short because you can manage your stop pretty closely. Some strong support levels. Target 1 being pivot, target 2 being down here if anyone's looking for some targets in this space over here. Now, following this, we have to talk about the Aussie dollar, which just saw a bit of a move lower yesterday. And if we transition this across. So neutral rate talk doesn't mean tighter policy is coming. RBA's DeBell says. The Australian Central Bank #2 official said that the board discussion on the levels of neutral interest rates at its July policy meeting should not be interpreted as a signal of plans to be tightened. This is basically them discussing where the neutral interest rate lies for Bank of Australia. It doesn't mean that they're looking to start to increase interest rates, and they have no intention of just following the global trend which seems to be forming about tightening monetary policy. This, however, has now been sort of reversed, at least 50% of it. The Aussie dollar as a whole has been ramping higher on the back of really good Asian data and Chinese data. I don't think that this comment in itself is going to cause this currency pair now to start to fall through the ground. I'd be a bit hesitant trying to counter trend just yet. If we can get back down to sort of these levels over here, we've got a nice double top to look for the long. And with commodity prices recovering pretty well. I haven't transitioned. And with commodity prices recovering pretty well, and generally good economic data coming out of Australia, I'll be looking for a bit more of a long position there. Now, just to sure everyone has read what's been happening with Donald Trump, and this is Donald Trump has this morning said that he will be looking to fire special counsel Robert Mueller for investigating Trump's business dealings as a part of the Russian probe. As much as Theresa May hasn't done anything, Donald Trump has done nothing. He's been in power, he's won elections, and he's just been trying to save his own face. This Russia probe he must be getting absolutely sick and tired of. But what? Again, the American equity market is so resilient, managing to bounce once again, and I'll talk about that again in a moment. But this just cannot continue indefinitely. If he continues to fire people, President Donald Trump's speculation may be considering firing special counsel Robert Mueller for investigating Trump's business dealings as part of the Russian probe. I just don't feel that this guy can continue to be considered to be a powerful leader who will hold much credibility in the international space, where if anybody who has the authority to look into any dealings that bad dealings that he's been involved with gets fired, then people will start to question whether he actually has something to hide. If we look at what happened to the equity space last night, we definitely saw some downside, but then the S&P managed to rally and basically finish unchanged, buying the dip once again, working very well. I want to see some more concrete evidence of him speaking more vocally about wanting to act on Robert Mueller going forward to see any downside in the equity market. But at the moment, the same trade which has been working for equities for many years now, looking to buy the dip. What we have been doing is the S&P 500 has finally started to move higher on the back of a dovish Fed, and I think this is going to continue in the long run. We still see soft data out of America coming out very well, and especially with dovishness from the Fed, this will continue. Now, will this Trump story really start to wear on equity prices just yet? Not so much. I think once again the market learns by experiences, and from experience we've seen that the equity space has been very resilient to any political risk, and Donald Trump in himself has been quite impressive in the fact that there have been quite a few issues which he's managed to face and still stay strong. Another point to this is, given the fact that the repeal and replace of Obamacare has sort of started to fall through, the only thing really left in terms of the things that he's promising to do would now be looking at the fiscal policy and spending plans that he was talking about. So it'll be very interesting if we see a shift of his focus onto those matters, and then the real question will come: can he implement these or can he not implement these? Okay, just having a look at the calendar ahead. It's a fairly quiet day. It's been a fairly quiet day, but a relatively good week. I'd expect the markets to stay sentiment driven. I'd be keeping an eye on the euro. If the euro continues to print higher, then I'd be expecting European equities to follow suit and print lower. All being said, I'm pretty impressed with the European equities, with the hawkish ECB, not hawkish ECB, with the positive ECB commentary that's been coming out. They've been pretty resilient. They're still at the top of their sort of yearly highs, consolidating very well, and generally we may see a bit of downside, but I'm definitely not worried about them selling off quite heavily. So I'll be looking at the euro as a lead indicator this time, as opposed to the Bund as what we're looking at after this interest speech, to gauge sentiment regarding the direction of the market this morning. Today we do have some data coming out of Canada, so if we do have any Canadian dollar traders over here, we have your inflation data coming out month on month, CPI inflations, core inflation coming out. Now, as a whole, as a desk, not a lot of us do trade the US CAD, but what I would say is what will be very interesting to see is, now we were going through in a period of very good inflation readings, which are now start to subside beginning 2017. So Canada being still quite a major economy in the world, keeping an eye on their inflation rate will definitely still feed into this either global inflationary picture or global deflationary picture. Keep a close eye on that. The newer guys, that's CA6 on the futures. If you wanted to keep your ladders open, have a look at how the market reacts. It's always very, very good to be looking at major data releases such as this, especially people who are relatively new and still trying to understand what liquidity is and what liquidity risk is, and how markets can move when you've got tier 1 data coming out. Highly recommend you guys keep an eye on that. Canadian retail sales, once again, just Canadian economic data coming out. And then Friday, as usual, the Baker Hughes rig count coming out. If I was to guess, I'd say this is definitely going to print another increase, just given the fact where oil has been trading. I've been fairly impressed with the oil market. There's no question, and even Russia are out saying that we are still in a huge glut. Oil has been remarkably buoyant for the past month, basically all of July. Oil's been going higher. I don't feel this is sustainable. The global picture on the oil market hasn't changed whatsoever. I speak about it quite regularly, so I'll leave that out today. So we're testing some key levels. There's 47, 47.05, this whole area being quite crucial. I think it would be very telling if we can start getting above the 48 mark. That would be phenomenal, but I don't think that's going to happen. If we start to approach the 48 mark, I'd be definitely looking to scale into some shorts there. In terms of technical levels today, in a situation where we're in such a bullish market, you don't want to fight the overall trend, but I definitely wouldn't be looking to get in long S1, irrespective of the fact that this level's been chopped up. Just the fact that if my fundamental view is a short, I'd be looking, and if I was going to follow that trend higher, I'd be definitely looking for the absolute extremity where we can see all of these bulls which have been driving the price higher to get involved in the market. So S2 looking pretty good, but ultimately I want to wait and see. If we can start getting around this 47.90, 48 mark. I think the better shorts are going to be coming in around there. R2 obviously 48.09. So we're at crucial levels with oil. There's a wait and see. Ultimately still bearish on oil prices. If we get up to R2, I'd definitely be looking for a short. Okay guys, that's your morning brief. Please feel free to drop me any questions in Trading Live. I'm not sure if Ant had posted out this Credit Suisse report to you guys as part of your research, but if you haven't, I think it's an excellent document. 30th of June, so it's a little bit dated, but it's incredibly relevant. If that hasn't been sent out to you previously, do let me know, and I'll be more than happy to email this out to you guys. Thank you very much, and good luck.